All right, guys, we got 7 minutes on the clock. We're going to talk about deals. We're going to talk about the world of investment banking, M&A, and learn about private credit. Matt, welcome to the show.
Thanks for having me, brother.
Yeah, man. All right, so talk to us in the world of investment banking, mergers, acquisition. What the heck is private credit? I have no clue.
Yeah, great question. We get asked that question a lot, and it's a cool thing to talk about because it's new, which means not everybody knows about it, which means that it's worth talking about, right?
For
Maybe
sure.
it can help some people. So, private credit is a term for an ecosystem of capital that is not from the bank. So it's a term for non-bank capital solutions that are used to fund a bunch of things that I think traditionally, like in middle America, Main Street American companies have been funded mostly just by straight equity, right? Whether it's private equity or PPM work, right? Dentist doctor money. And really what it is really cool is it's the efficiency that has always existed or has existed for a long time up market with large public companies and large private equity owned companies coming down market to what I would call, lower and middle market companies, Main Street American companies,
Mhm.
to provide capital for all the things that banks generally hate at 4 or 5% money. They traditionally had a choice like, okay, I'm going to go to my banker, right? If I own a company, right, or I manage a company, I'm going to go to my banker. You're going to say, I want this, and they're going to say yes or no. That's like 4 to 7% money. And if they say no, you either don't do it or you go get, massively dilutive 30% cost of capital straight equity and not in the in between, right? Whereas large companies have, a bank deal, they've got a second lien deal, they've got high yield, they've got converts, and they've got the public markets. It's the efficiency of capital coming down market to Main Street American companies. And it's really cool because what it spits out at the bottom, if you utilize this capital in the right scenarios, are sometimes paradigm shifting opportunities for private companies. So acquisition finance, right? Or I run a software company and I don't actually have any collateral. So the banker doesn't like me, but boy, I really don't want to, give away all of the equity in my company. Distressed financing, we're now seeing it used by private companies to roll up companies like private equity firms have, but without the private equity company and keeping the equity returns in markets. So it's this pocket of non-dilutive capital that will allow for all the things that banks don't generally want to do that you traditionally had to do with equity at a really high cost of capital and with a lot of governance on a more efficient basis. So it's the pocket of capital between kind of 7% cost of capital, probably where banks start right now, and 25 or 30% cost of capital where private equity firms really want to invest.
Got it. So let's just say I'm looking to do a roll up, right? Or maybe in the situation of a distressed group, right? Last couple of years have been pretty tough, right? And I'm looking at this and I'm going, man, dilutive. I met with a construction company this morning. He goes, we got all these projects coming up, but we don't have, like, what do we go sell shares? What? So how does this actually work?
Yeah. So the way it works, and this isn't meant to be a plug, but it's just how all of our conversations start, right? So if you're an investment banker and somebody's going to sell a company, they interview 3 or 4 investment banks. It's a beauty pageant. They pick somebody. These conversations all start with a business owner or management team saying, I've got these wants, needs, or problems. And then we start with an options analysis. Okay, here are all the ways to fund that, what is and what isn't possible, and the various pockets of capital, which is really cool, right? So it's a solutions-based approach. And all we're really doing is pairing really deep private capital market relationships with those wants and needs and problems of a private company. And it can look like a lot of things. It can be unitranche debt, which is basically like supersized term loan, right? It can be structured credit, which is, and by the way, unitranche is probably like 10 to 12% cost of capital in today's market. Looks a lot like a traditional bank deal, except, oh, pretty cool. You don't have to have a personal guarantee. And instead of 5-year amortization and really heavy principal payments, you're doing 100-year AM, all the way to structured credit, structured equity, debt equity, which are highly bespoke capital structures that are, very flexible and maybe like 15 to 20% cost of capital. So it's really bespoke financing solutions to pair with the wants and needs of private companies.
Got it. So that's on the company side, receiving, right? So you create some, here's the solutions, here's some options, right? On the
Exactly.
flip side, there's someone who's going to be supplying that equity or the capital.
I
So
like
like,
it. You're going to use that word, aren't you?
oh, of course, and I'm totally going to use there's PPM, private placements, and then there's DPM, dentist doctor money. So DDM, PPM. I like that. I'm going to use
There
that
we
all the
go.
time. So,
Yep.
but on the doctor dentist side, the person writing the check or maybe coming to you saying, "Hey, I am looking for capital for opportunities." Like what does that look like?
Yeah, it's generally somebody that says the on the company side, it's some, they have a capital need or a want or a desire, and the bank has said no, and or they've been approached by a private equity firm to underwrite them, and they're saying, should I do it, right? Or, is there somebody else to do the deal that the bank told me that they wouldn't do? That's how it usually starts. And then these deals are funded by, think of private equity funds, except
Mhm.
they've got a different mandate. They invest on a little bit more secured basis, but still very much the same thing. And they want to put money to work. And in fact, they actually usually want to put more money to work, not give me my money back. And but in a very similar fashion. So mostly funds, family offices also do this direct lending, right?
Mhm.
So, Michael Dell's family office, for example, has a private debt, private credit arm to put capital to work in this manner. But all private money, all that's not, borrowed on SOFR is called money from, the same capital base, basically.
Yeah. So Matt, I got another question. What is private credit? No, I'm just kidding. You did an absolute phenomenal job at explaining this opportunity for both companies and people who want to, deploy some capital and get money working for them. Matt, where could people go to find out more about you and maybe get that solution that you guys provide?
Yeah, thanks for asking. Bridgepoint IB, as in investmentbanking.com, is the place to go. There's a bunch of resources on there too for private companies. And would love to talk to anybody that's interested in the product.
Cool, guys. We did that all in 7 minutes or less. As always, reach out to our guests and say thanks for being on the show. And if they could help you with what you're working on, their contact information will be in the show notes below. If you have a deal that you'd like to talk about, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, we'll talk to you all on the next episode. Love you. Bye bye.